Imagine running a global retail empire where foot traffic is down, fewer people are checking out at the register, and yet somehow you just made millions of dollars more than you did last year.
Yeah, I mean, it genuinely sounds like a math error.
Right. Well, welcome to today's deep dive. We are looking at a single document that explains exactly how a retailer pulls off that magic trick.
It is a pretty wild document, honestly.
It really is.
Yeah.
So we are unpacking a Form 10Q filed with the SEC on June 4, 2026.
Right.
And this is for the quarter ending May 2, 2026. The subject is Zumiez Inc., the global retailer famous for action sports, streetwear, and youth culture.
Exactly. And to most people, I mean, a 10Q is just a dry financial document full of lawyers arguing over commas.
Totally. But if you know how to read it, it's basically a secret decoder ring for understanding the global economy, the shifting landscape of physical retail, and honestly, the psychology of teenage consumers.
Oh, absolutely. Teen psychology is right there in the spreadsheets.
So whether you are an investor, a business owner, or just someone who is insanely curious about how a $193 million quarter actually works, there is a massive story hiding in these pages. Okay, let's unpack this.
It really is the perfect starting point. I mean, a first quarter financial report from a youth apparel retailer like Zumiez acts as a brilliant bellwether for discretionary consumer spending.
Because it's not essential.
Exactly. Teen fashion isn't a necessity, it is a choice. So when you look at how these dollars are flowing, you are getting a real-time snapshot of consumer confidence, the impact of inflation, and shifting behavioral trends on a global scale.
And, the top-line numbers for this quarter present a really strange puzzle. We are looking at net sales of $193.3 million.
Which is pretty impressive.
Yeah, that is up 4.9% from the exact same period in 2025. And their comparable sales, which, just to clarify, combine sales from stores that have been open for at least a year with their e-commerce sales.
Right.
Those increased by 4.0%.
And, on the surface, Wall Street looks at that and sees a very straightforward, healthy growth story. Top-line revenue is expanding.
But when you dig into the footnotes, you hit this wild contradiction. Foot traffic to their physical stores actually decreased.
Fewer people walking through the doors.
And the total number of transactions, like the literal number of times someone swept a cart at the register or clicked checkout online, that also decreased.
It's a huge drop-off.
Fewer people are walking in and fewer purchases are being made. I have to wonder why that is happening in the first place.
Well, there are a few theories on that.
Are we seeing the permanent impact of ultra-fast fashion apps training teenagers to just buy from their beds? Or are teenagers simply hanging out at the mall less post-pandemic?
It is likely a combination of both, actually. Digital socialization has absolutely replaced physical mall lingering for many younger demographics.
That makes sense.
And hyper-fast fashion competitors operate at a speed physical retail struggles to match. But what's fascinating here is the underlying mechanics of how Zumiez grew their revenue despite those headwinds.
Because the math doesn't seem to add up at first glance.
Right. If you have fewer people buying things, the only mathematical way revenue goes up is if the people who do buy are spending significantly more money every time they reach the register.
Okay, so they're just buying more stuff per trip.
Exactly. In retail, this is driven by two specific metrics. The first is average unit retail, or AUR, which simply means the items themselves cost more.
Right, whether through price increases or a shift toward more premium products.
Yep. The second is units per transaction, or UPT, meaning people are just putting more individual items into their shopping bags before they check out.
So categories like men's clothing, hard goods, which would be things like expensive skateboard decks or snowboards, and accessories drove this surge, while footwear actually lagged behind.
Yeah, footwear took a hit.
It reminds me of the Costco effect.
Oh, I like that comparison.
You go to the store less often because you're busy, or you're just doing most of your casual browsing on your phone. But when you finally do make the trip to the physical store, you absolutely fill the trunk to justify the effort.
That is a very apt analogy. The consumer behavior shifts from casual, frequent browsing to intentional, high-volume purchasing.
Right.
When they show up, they are buying the skateboard, the grip tape, the wheels, and a hoodie to go with it, all at once.
So let me push back on that strategy for a second. Costco sells bulk groceries. Zumiez sells youth fashion.
Fair point.
Is it dangerous for a mall-based retailer to rely on fewer shoppers carrying heavier baskets? It feels like you're just kind of squeezing more and more money out of a shrinking pool of diehard fans.
That vulnerability is exactly what management has to monitor. It is a risk.
Because if that core group suddenly gets squeezed by inflation and cuts back, Wouldn't the whole house of cards topple?
It's a tightrope walk for sure. Relying on higher prices and larger basket sizes to mask declining foot traffic has its limits. There is absolutely a ceiling to how much a teenager or young adult is willing or able to spend in a single trip.
Yeah, exactly.
However, it's also important to remember that top-line sales, whether they come from many small baskets or a few massive ones, do not equal profit. Taking in more cash at the register is really only half the equation.
Right, because it costs money to run the stores.
Precisely.
Right.
We have to look at what it actually costs them to fulfill those bigger baskets and run this global empire during those 3 months.
Which means we need to look at the profitability puzzle.
Yes.
And their gross profit jumped 10.9% to $61.3 million. I mean, the margin improvement is impressive. They increased their gross margin by 170 basis points, bringing it up to 31.7%.
A 170 basis point improvement is massive in specialty retail.
Wow, really?
Oh, yeah. For context, that means for every $100 in sales, they kept an extra $1.70 in gross profit compared to last year.
Okay, that adds up fast.
It does. And the sources outline exactly where they found those operational wins. They had better product margins, meaning the gap between what they paid to source the clothes and what they sold them for widened.
Okay, so they brought it cheaper or sold it for more.
Right. They also saw lower web shipping costs. And importantly, they had a net closure of 16 underperforming stores since the same time last year.
Trimming the fat.
Exactly. By trimming the fat, they gain leverage on their occupancy costs.
Wait, leverage on occupancy costs, you just mean that by closing the dud stores, the rent they are paying on the remaining successful stores looks much better against their overall profit, right? Like they aren't dragging around dead weight.
Precisely. You are concentrating your sales volume over a smaller, more efficient real estate footprint.
Makes total sense.
But perhaps the most interesting operational win mentioned in the 10Q is a reduction in inventory shrinkage.
A shrinkage is just the retail industry's catch-all term for theft, lost inventory, and damaged goods, right?
Yes, exactly. Controlling that directly pads the gross margin. They also managed to keep their selling, general, and administrative expenses, their SG&A, in check.
And just to be clear for anyone listening, SG&A is the day-to-day cost of actually running the business, right?
Yeah.
Like paying the store clerks, keeping the lights on, corporate salaries, the marketing budget, all that stuff.
Yes, all the operating expenses outside of the direct cost of the merchandise itself. Though it is worth noting, their comparison to the prior year was aided by a $2.9 million litigation settlement.
Oh, interesting.
Yeah, that hit the books last year but didn't repeat this quarter, so it made this year look a bit better by comparison.
So let's add this up. Sales are up. Margins are up. Shipping costs are down. Theft is down. They closed unprofitable stores. By all conventional logic, they should be rolling in cash.
You would think so.
Here's where it gets really interesting. Despite all of those operational wins, Zumiez still posted a net loss of $13.3 million for the quarter.
A pretty significant loss.
That is a loss of 82 cents per share. How does a company do everything right on the operational side and still burn through $13 million?
Well, you have just hit on one of the most defining and brutal characteristics of the retail industry.
Which is?
We can call it the seasonality trap.
Yeah.
Zumiez, like many specialty apparel retailers, does not generate its profit evenly over a 12-month calendar.
Oh, because kids aren't shopping as much in the spring.
Right. They disproportionately rely on the third quarter, which is back to school, and the fourth quarter, the winter holidays.
So the first 2 quarters of the year are just a waiting game.
They are basically about survival and preparation. Q1 and Q2 are spent accumulating inventory, testing out new fashion trends on a smaller scale, and, maintaining the store fleet.
But they still have to pay all those fixed leases and staff salaries.
Exactly. You are incurring a massive portion of your annual operating expenses while experiencing your absolute lowest sales volumes.
That sounds terrifying.
The $76.5 million they spent on SG&A this quarter doesn't vanish just because teenagers aren't shopping for heavy jackets in March and April. The rent is still due.
Wow, imagine running a business like that for a second. Think about the psychological toll. You essentially have to make your entire year's profit in a few short, high-stress weeks in August and December.
It's incredibly stressful.
You spend half the year intentionally bleeding cash, knowing you have to nail the back-to-school trends perfectly, or your whole year is ruined. Your margin for error is practically zero.
It creates an incredibly high-pressure environment.
Yeah.
And that reliance on a few crucial weeks perfectly sets the stage for the most revealing section of any 10Q, which is the risk factors.
Oh, I love that section.
If your entire year rests on back-to-school and holiday sales, any macro force that disrupts those specific narrow windows can be devastating.
Whenever I look at these financial documents, I always skip right to the risk factors. It's the one place where corporate PR is legally forced to drop the marketing spin,
Yeah, they have to be completely honest.
They literally have to confess their darkest nightmares to Wall Street. It is pure, unfiltered corporate anxiety.
It is a legally mandated reality check. And for Zumiez, when synthesizing the sources, three massive external risks really dominate their threat landscape. First is the mall ecosystem itself.
Right, because they are everywhere.
They operate 714 global stores, and the vast majority are located inside traditional shopping malls. They rely heavily on the foot traffic generated by the mall's anchor tenants.
And by anchor tenants, you mean the giant department stores. Because let's be honest, almost nobody drives to a massive suburban mall just to visit a 2,000 square foot streetwear shop.
Exactly.
They go for the giant department store, they go to the movie theater, maybe the food court, and then they kind of just wander into Zumiez along the way.
Yeah.
Zumiez relying on the gravity of those bigger stores to pull teenagers into their orbit.
That is the exact dynamic. If a mall's popularity declines, or if an anchor tenant goes bankrupt and boards up its windows, Zumiez suffers the collateral damage. It really doesn't matter how incredible their product selection is. If the mall ecosystem dies, the foot traffic vanishes, and their localized revenue plummets.
But even if they figure out how to get teens into the physical mall, they still have to actually get the products onto the shelves. And the 10Q points out that a massive amount of their merchandise is imported from Asia.
Which brings us to the second major risk, the global supply chain and tariffs.
Right.
And I want to be clear, the financial threat here is strictly mathematical. We are purely looking at the accounting side of this, completely divorced from any political stance.
Exactly, just looking at the numbers.
Changing international trade agreements, sudden port strikes, or the implementation of new tariffs would significantly raise the cost of importing their merchandise. It's an input cost issue.
So they are trapped by the math. If a sweeping tariff hits, the cost to bring a T-shirt into the country spikes. They either have to eat that cost, which destroys their profit margin, or they have to pass that cost onto the consumer, which risks pricing teenagers out of the market entirely. I mean, a teenager might pay $30 for a graphic tee, but they simply won't pay $50.
Precisely. It is an input cost problem that management has very little ability to control.
But let's say the supply chain works perfectly.
Okay.
The trade agreements hold, the ports operate smoothly, and the product arrives exactly on time for the crucial fourth quarter. They still have to sell it, and they are selling highly seasonal gear. What happens if December is like 80 degrees?
Then they fall victim to the third major risk, which is unseasonable weather.
Oh man, yeah.
A significant portion of their Q4 holiday profit relies on selling high-margin, expensive winter gear. We are talking about snowboards, heavy outerwear, boots, and thick hoodies.
Stuff that you absolutely do not need if it's warm.
Right. If the winter is unseasonably warm across their key markets, that inventory simply doesn't move. They are left stuck with warehouses and stockrooms full of winter gear that they are forced to sell at massive markdowns in January just to clear it out.
Which vaporizes their profit margins for the year.
Exactly.
Okay, let's step back and look at this objectively.
Yeah.
You are completely dependent on mall anchor stores you don't control. You are at the mercy of global supply chains and international trade policies you can't influence.
Yep.
And on top of all of that, your most profitable season can be completely wiped out by a warm month of December. With all these uncontrollable macro factors, isn't physical retail just a sitting duck?
It definitely looks that way.
Like, why even bother carrying the lease on 714 stores if they make you this vulnerable?
If we connect this to the bigger picture, those exact risks are precisely why their strategy is so deeply focused on omni-channel retail.
Omni-channel.
Yes. The physical stores are no longer just places for a customer to walk in and buy a shirt. They act as an integrated logistical defense mechanism against those exact threats.
Wait, are you saying they use the physical stores as mini warehouses?
Exactly.
So if I order a skateboard online, it might be shipping from the mall down the street rather than a massive centralized warehouse in Nevada.
That is exactly what they do. Those 714 stores function as localized fulfillment centers for their e-commerce business.
Oh, wow.
This provides incredible flexibility. If there is a supply chain hiccup that delays inventory to the West Coast, or if one region gets a warm winter while another gets a blizzard, they can dynamically shift their inventory.
That is incredibly smart.
They can fulfill an online order by shipping a heavy winter jacket directly from a store in Florida where it isn't selling due to the heat to a customer in Colorado.
So the stores are basically nodes in a massive, flexible network designed to mitigate the exact macro risks we just discussed.
Yes.
That is a brilliant way to rethink real estate. It turns a massive liability like paying rent on hundreds of physical stores into a logistical advantage.
It really does.
But squeezing that kind of logistical efficiency out of a store network requires serious cash. Which brings us to the final piece of the 10Q puzzle, the balance sheet.
Right?
How is the management team actually spending your money to defend the company against all this volatility?
Well, this is where you separate the theoretical strategy of a company from the actual conviction of its leadership. Looking at the balance sheet, Zumiez is sitting on a very comfortable cushion.
How comfortable?
They have $73.1 million in cash, cash equivalents, and restricted cash. Furthermore, they maintain a $25 million revolving credit facility, and they have 0 outstanding borrowings on it.
So they have no debt on the credit line and over $70 million in cash.
Yeah.
That's a fortress balance sheet.
It is.
Where's that capital actually going?
They are making 2 major moves with that capital. First, on the physical footprint side, they are planning $14 to $16 million in capital expenditures for the year.
Okay, building things out.
Right. This is primarily allocated for fixtures for about 5 new stores, alongside remodels and relocations of existing stores. So despite the mall risks, they are still carefully investing in modernizing their physical presence.
Interesting. And the second move?
The second move is a massive financial bet on themselves. On March 11th, 2026, their board of directors approved a $40 million share repurchase program.
Oh, wow.
During this first quarter alone, they spent $6.2 million buying back 265,000 of their own shares at an average price of $23.56.
For anyone listening who might not follow Wall Street mechanics closely, think of a stock buyback like a pizza.
I like this.
The company is the whole pizza, and the shares are the slices. If management uses the company's cash to buy back slices and take them out of the box entirely, the remaining slices just got mathematically bigger for everyone else who still owns one.
That is a great way to picture it.
They are looking at the mall decline, the winter weather risks, and the supply chain threats, and they are saying, we still think our pizza is the absolute best investment out there.
That is exactly the signal it sends. A stock buyback is the ultimate demonstration of management's conviction. By reducing the number of outstanding shares, they're increasing the ownership stake and the future earnings per share of every remaining investor.
Right.
It signals that management looks at the entire landscape, including their own Q1 net loss of $13 million, and concludes that the market is undervaluing their stock.
Wow.
They believe investing in their own business model yields a higher return than holding the cash or, acquiring someone else.
So what does this all mean? I think for you listening right now, this is a profound lesson in business confidence and capital allocation.
Absolutely.
When you are faced with massive external volatility,
Yep.
things you absolutely cannot control, like the weather or global trade, the best defense isn't to panic and pivot your entire business model.
Right. You don't just abandon ship.
Exactly. The best defense is to maintain a strong, flexible balance sheet, keep cash on hand, and double down on your core strategy. I mean, they lost $13 million this quarter, but they are so confident in their Q3 and Q4 seasonality and their omni-channel defense that they are buying back their own stock. That is structural, deep-seated confidence.
It really is a masterclass in allowing a calculated long-term perspective to override short-term seasonal noise.
We have covered a lot of ground today. We started with what looked like a boring stack of SEC disclosures from a teen apparel retailer, and we unpacked a massive story about consumer psychology.
We really did.
We looked at the sales paradox, how foot traffic is down, but AUR and UPT are up, showing us consumers acting like Costco bulk shoppers inside a streetwear store.
Which is still wild to think about.
Right. We explored the intense high-stakes pressure of retail seasonality, where the survival of the entire year rides on a few chaotic weeks. And we mapped out a complex web of risks, from the slow decay of mall anchor stores to the vulnerabilities of global supply chains, all defended by an omni-channel strategy.
This raises an important question, doesn't it?
What's that?
It reminds us that behind every simple, everyday transaction, a teenager buying a hoodie with a debit card, There is a massive, highly sensitive, interconnected global machine turning in the background. Every single link in that chain, from the Asian manufacturing facility to the Florida mall storefront, has to hold for that transaction to happen profitably.
It really does change the way you look at them all. Before we wrap up, I want to leave you with one final provocative thought to mull over.
Okay.
We talked about all the external risks listed in the 10Q, but one of the explicitly listed threats is failing to anticipate fashion trends.
Right, which is huge in that demographic.
Exactly.
Yeah.
Right now, human buyers at Zumiez are trying to guess what teenagers will want to wear 6 months from now.
Okay.
But as we move deeper into a world dominated by predictive artificial intelligence, we have to ask, will machines eventually be able to perfectly predict the chaotic, rebellious tastes of youth culture and streetwear?
That is a fascinating thought.
Right. Can an algorithm mathematically solve teenage angst? Or is human fashion, driven by pure emotion and rebellion, the one thing an AI will never fully anticipate? Will that secret decoder ring eventually be worn by an algorithm?
Only time will tell.
Thank you for joining us on this deep dive. Keep questioning the world around you, keep looking past the surface of the numbers, and we will see you next time.